12.2 Information Problems in Insurance Market. Just as buyers and sellers gain from trading goods and services, so they can also gain by trading risk. People trade risk in financial markets and insurance market, but risk is a bad, not a good. The good that is traded is risk avoidance. Insurance markets. Insurance reduces the risk that each person faces by sharing or pooling the risks. When you buy insurance against the risk of an unwanted event, you pay an insurance company a premium. If the unwanted event occurs, the insurance company pays you the amount of the insured loss. People are happy to buy insurance at prices that enable insurance companies to make a profit because they are risk averse. They don't like risk, and by spreading the risk, insurance companies lower the risk for everyone. But insurance companies do have a problem. It is a general problem that affects all type of insurance. Their customers have private information about their own behavior and its effects on the likelihood that they will make an insurance claim. There is asymmetric information in the insurance market. Asymmetric information in insurance. Although asymmetric information is present in all types of insurance, we will stick to auto insurance. Some drivers are careful and some are aggressive. A careful driver is less likely to have an accident than an aggressive driver. Each driver knows which type he or she is, but insurance company doesn't know. Yet it would benefit the insurance company to know, for it could then charge the higher risk aggressive driver a higher premium and the lower risk careful driver a lower premium. Without knowledge about driver types, all insured drivers get the same deal. There is a pooling equilibrium like that in the used car market without dealer warranties. Careful drivers and aggressive drivers pay the same premium, but the insurance companies incur losses on aggressive drivers and make profits on careful drivers. Figure illustrate this pooling equilibrium output. The demand for collision insurance by careful drivers is DC and demand by all drivers is D. The horizontal distance between the curves DC and D is the quantity demanded by aggressive drivers at each price. The insurance companies don't know the driver types to which they are selling, so the supply curve S is the same for all drivers. It is based on an average of the marginal cost of insuring an aggressive driver and the marginal cost of insuring a careful driver. In this example, the equilibrium premium is $1,000 a year, and 60 million careful drivers and 60 million aggressive drivers are insured. This outcome is inefficient for two reasons. It creates moral hazard and adverse selection. In this equilibrium, moral hazard and adverse selection make insurance companies look for ways of separating the two driver types. Moral hazard. It is a tendency for a person with private information to use it in ways that impose cost on an uninformed party with whom they have made an agreement. Insurance companies face moral hazard because an insurance person is less likely than an uninsured person to behave in ways that avoid the insured loss. For example, fire insurance lessens the incentive to install smoke detectors, fire alarms, and a sprinkler system. In case of auto insurance, a driver with full collision coverage has less incentive than a driver with little or no collision coverage to drive carefully. Once a person has bought insurance, her incentives change, and the change adversely affect the interest of the insurance company. Adverse selection arises because people at greater risk are more likely to buy insurance than those for whom a risk is very small. For example, a person with a family history of serious illness is more likely to buy health insurance than a person with a family history of good health. Similarly, an aggressive driver is more likely than a careful driver to take the fullest possible coverage. So more of the insurance risk arises from the activities of the riskiest people. Insurance companies have an incentive to find ways around the moral hazard and adverse selection problems. By doing so, they can lower premiums for low risk people and raise premiums for high risk people. Screening in insurance markets. Screening occurs when an uninformed person creates an incentive for an uninformed person to reveal relevant private information. Insurance companies use the no claim bonus and low risk careful drivers and set premiums in line with the risk arising from the two types of drivers. No claim bonus. A no claim bonus is a discount that insurance premium for drivers who don't make claims. A driver accumulates a no claim bonus by driving safely and avoids accidents. The longer the period of no claim, the greater is the incentive to drive carefully. The no claim bonus enables the informed driver to reveal his or her type of the uninformed insurance company and get insurance at a lower price in line with the lower risk that the driver presents. A driver who makes claims also reveals her or his type to the insurance company and gets insurance at a higher price in line with the higher risk that the driver presents. The no claim bonus helps to lessen the moral hazard problem. With a bonus at stake for making a claim, a driver has a stronger incentive to be careful and try harder to avoid accidents. Deductible. Insurance companies also use a deductible. A deductible is the amount of a loss that the insurance person agrees to bear personally. The larger the deductible, the lower is the premium, and the decrease in the premium is more than proportionate to the increase in the deductible. By offering insurance with full coverage, no deductible on terms that are attractive only to aggressive high-risk drivers, and by offering coverage with a deductible on more favorable terms that are attractive to careful low-risk drivers, insurance companies can do profitable business with everyone. Aggressive high-risk drivers choose policies with low deductible and a high premium. Careful low-risk drivers choose policies with a high deductible and a low premium. The size of the deductible chosen reveals to the insurance company whether the driver is aggressive or careful. Separating equilibrium with screening. With screening that indicates driver types, insurance companies can supply insurance on different terms to the different groups. With only two groups, aggressive and careful, it can offer premiums at two different levels. A higher premium for aggressive drivers and a lower premium for careful drivers. The higher premium is an incentive for aggressive drivers to behave as if they were careful. So the number of aggressive drivers decreases and the number of careful drivers increases. The outcome is a separating equilibrium. Figure illustrates this outcome and contrasts it with the pooling equilibrium that arises without screening. The figure A shows a situation for careful drivers and figure B for aggressive drivers. We are assuming that the two groups are of equal size in the sense that they have identical demand curves DC and DA. But two groups don't end up of equal size when they have responded to the incentives they face. Careful drivers. Without screening provided by a no-claim bonus and deductible, insurance companies offer the same supply of insurance to all drivers. The equilibrium without the screening is the same as in figure. Everyone pays $1,000 a year and there are 60 million of each type of driver. With screening, the insurance companies base their supply to each group on the marginal cost of serving them. For careful drivers in Part A, the supply curve is MCC. The equilibrium insurance is $800 a year and the number of drivers who are careful drivers increases to 80 million. Without screening, the market underprovides insurance to this group and is inefficient. With screening, the market is efficient. Aggressive drivers. For aggressive drivers, the marginal cost of serving them is MCA, and this marginal cost determines the supply of this group. The equilibrium insurance premium is $1,200 a year, and the number of drivers who remain aggressive decreases to 40 million. Without screening, the market overprovides insurance to this group and is inefficient. Again, with screening, the market is efficient. These two examples of markets with asymmetric information in which the creative signaling and screening what would be market failure and achieves an efficient outcome.